Welcome back. If you've been with us on this journey through strategy, sustainability, and management accounting, you know we've spent a considerable amount of time looking outward. In our previous discussions, we navigated the turbulent waters of the market domain. We explored how firms position themselves against competitors, how they calculate their moves through life cycle costing, and how they engage in the high-stakes game of dynamic pricing. We were looking at the firm as it faces the world. But in this episode, we are turning that gaze inward. We are stepping inside the corporate structure to ask a fundamental, perhaps even uncomfortable question. Once a strategy is formulated, how does the hierarchy actually get it done? This is part 1 of a special 2-part series on the first of the 3 chapters on strategy in the hierarchy. We are going to explore the machinery of performance management, while management control and organizational resilience will be discussed in the next 2 chapters. This discussion unfolds across 3 interconnected themes. First, we have the traditional approach, the bedrock of financial control known as responsibility accounting. Second, we have the strategic approach, best exemplified by the famous balanced scorecard, which attempts to fix the blind spots of tradition. And third, we have the emerging, complex frontier of sustainability. How these systems handle, or fail to handle, social and ecological justice. In this episode, our focus is squarely on that first theme, the traditional approach. We are going to deconstruct the philosophy of responsibility accounting. We need to understand the logic that governed the 20th century corporation and still governs much of the world today. To understand why it is no longer enough, but before we can manage performance, we have to agree on what performance actually is. Let's pause here for a moment. Think about your own daily life. You engage in countless activities. You read, you study, maybe you sing in the shower or go for a run. In the workplace, employees are writing, cleaning, entering data or operating machines. They are activities. But, as the chapter highlights, simply doing something does not constitute performance. So, when does an action or an activity transform into a performance? The distinction lies in observation and judgment. If you dance alone in your living room, are you doing something or just acting? But if you dance on a stage to win a prize, subject to the gaze of judges, you are performing. Performance consists of goal-directed actions and outcomes that are subject to observation, evaluation, and judgment, often followed by rewards and/or punishments. This is critical because performance underpins the distribution of power, status, and resources. In a university, a student's reading becomes performance when it is tested in an exam. In a corporation, a manager's decision becomes performance when its outcome is ranked and rewarded. Effectively, performance is a hybrid concept. It is the collision of the actual, what you did or produced, and the expected, what the institution wanted you to do or produce. The goal of performance management is to increase the alignment between your actual actions and the organization's objectives. Now, this sounds straightforward. But how do you institutionalize this across a massive, complex organization? How do you ensure that a factory worker in a machine shop and a sales director in a regional office are both performing in ways that serve the company? This brings us to the traditional engine of corporate control, responsibility accounting. Developed over centuries in Western organizations, responsibility accounting is a fascinating act of translation. Organizations are naturally techno-managerial hierarchies. They are arranged by expertise. Engineering, medicine, legal expertise, administrative or managerial expertise, and so on. A hospital is organized around medical care. A factory is organized around production flows and divisions. A university is organized around disciplinary demarcations of knowledge. But responsibility accounting superimposes a financial logic over these techno-operational structures. It demands that the logic of healing patients or making cars be translated into the logic of money. It redefines a machine workshop, a place of engineering, as a cost center, a place of financial accountability. This system relies on three main philosophical pillars. First, we have the hierarchy of accountability centers. The organization is sliced up into distinct types of responsibility. At the bottom, you typically have cost centers. These are units, such as a maintenance department or a workshop, where the manager is strictly responsible for keeping expenses within limits. They don't sell anything, they consume resources. Moving up the ladder, we find revenue centers. These are your sales departments, responsible for generating income but not necessarily for the costs of production. Then, we combine them into profit centers. Here, a manager is responsible for both costs and revenues, contributing to the bottom line of their specific division. And finally, at the very pinnacle of this structure, we have investment centers. These are the top-level units where managers are held accountable, not just for profit, but for the return on the capital invested to generate that profit. Not only short-term profits, but also long-run profits and cash flows, which, as you know, need to be measured in terms of net present value. This creates a pyramid. At the top sits return on investment, ROI. This is the dominant higher-order principle of the traditional firm. It reflects a pure capitalist logic of accumulation. Every cost center, every revenue target, every profit goal down the line is ultimately directed toward feeding that ROI at the top. The second pillar of this system is accounting calculations. Once you've defined these centers, you need tools to make them accountable by measuring their performance. This is where the familiar toolkit of management accounting comes in. Budgeting, standard costing, variance analysis, and ratio analysis. Think of these as the sensors in the machine. Budgeting sets the plan. Standard costing sets the benchmark, the expected performance. And variance analysis sounds the alarm when the actual deviates from that expectation. It's a control loop designed to keep the ship on the course of capital accumulation. The third pillar is the concept of controllability. This is a principle of fairness. It states that a manager should only be held accountable for what they can actually control. If a global economic downturn crashes sales, or a hurricane destroys the factory, the theory says the manager shouldn't be penalized for those uncontrollable variances. So, there you have the traditional machine. It is logical. It is hierarchical. It translates the messy reality of work into clean, comparable financial numbers. It allows a board of directors to look at a vast multinational corporation and see it all through the single lens of ROI. But, and this is the crucial turning point in our story, this system is flawed. As we moved into the modern strategic era, the cracks in responsibility accounting began to show. Critics, including strategists like Robert Kaplan, began to argue that this system suffers from a lack of balance and, perhaps more dangerously, a lack of strategic connection. Let's look at why. First, responsibility accounting tends to foster centralized, rigid organizations. It is often dominated by accountants who may understand the numbers but lack the techno-managerial expertise to understand the actual operations, the engineering, the science, the creativity, the medicine. Second, it is backward-looking. It relies on budgets and historical standards. It compares today's performance against yesterday's benchmarks. In a rapidly changing market, the kind we discussed in our previous episodes on dynamic pricing. Looking in the rearview mirror is a dangerous way to drive. Third, and this is a very human problem, it creates budgetary slack. Because managers know they will be judged on meeting a budget, they game the system. They underestimate their revenue potential and overestimate their costs to create a safety net. The system encourages mediocrity rather than ambition. But the most significant weakness is the financial bias. By superimposing a financial logic over everything, responsibility accounting makes all other purposes, innovation, quality, employee well-being, sustainability, secondary to capital accumulation. It focuses on operational efficiency, doing things right rather than strategic effectiveness, doing the right things. A manager might cut R&D spending to meet this quarter's profit target. The responsibility accounting system would likely reward them for achieving their budget. But strategically, they may have just sacrificed the company's future. This tension between the need for financial control and the need for strategic agility set the stage for a revolution in performance management. The business world needed a way to impart strategic meaning to performance, to look beyond the narrow financial focus. This brings us to the edge of our next discussion. We have established that the traditional hierarchy is a powerful machine for efficiency, driven by ROI. But we have also seen that it is blunt, backward-looking, and often strategically blind. How do we fix this? How do we balance the need for innovation, customer satisfaction, and growth while balancing the checkbook? In part 2 of this series, we will introduce the solution that dominated the management scene in the 1990s and remains vital today: the balanced scorecard. We will explore how Kaplan and Norton proposed to strategize the hierarchy, linking the day-to-day operations of the staff directly to the long-term vision of the company. And we will critically examine whether these new tools actually work, or if they bring new problems of their own, particularly when we try to integrate sustainability into the mix. As we close this chapter on the traditional approach, ask yourself, in your own organization, are you being measured on your contribution to the strategy? Or are you just a line item in a cost center? Join me next time as we try to balance the equation.